The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed.
Joining us now is 42 Macro founder and CEO Darius. Darius, great to see you. Thanks so much for joining the conversation.
Thank you for having me, Maria.
So
it's great
I noticed
to be back.
over and over again, Jay Powell says over time. We'll get to the target over time. He's signaling that it almost feels like he's recognizing he's not going to get to 2% anytime soon on inflation. What are your thoughts on the Fed's moves?
Yeah, absolutely. So yesterday was a step in the wrong direction in terms of the Fed's policy. It looks as if the Fed's starting to guide for higher for longer. But the reality is, from the perspective of asset markets, this is a Fed that is kowtowing to fiscal dominance. This is a Fed that is going to accept and implicitly is accepting much higher than 2% inflation, is likely to do that for quite a while.
So what will that mean for rates? Do you think that there's a chance he actually hikes rates, or are the 3 rate cuts off the table in your view? How do you see it?
Yeah, well, you go back and you look at 100 years of data. Whenever the monetary authority kowtows to fiscal dominance, you're talking about that's a structurally bullish dynamic for at-risk assets, stocks, credit, and a structurally bearish dynamic for the bond market. And I think that's exactly what we saw thus far throughout 2024.
Kowtowing toward fiscal policy, meaning just accepting the fact that the spending is continuing and inflation will be elevated.
Exactly. So if you go back and you look at 2023, the federal budget deficit grew by $364 billion. And we're still feeling that impact in terms of consumer spending, in terms of inflation. And as long as we continue to see excessive budget deficits, we're likely to have a structurally higher nominal GDP environment. That's great for stocks, but it's obviously terrible for bonds.
Adam, how do you see it? Jump in.
Yeah, well, I hear you, Darius, talking about despite the Fed's best efforts, Congress keeps spending money. It's an election year, and that's what they do. But here's what I wrestle with. So help me understand this. There are 4 measures of inflation, right? Consumer prices, producer prices, personal consumption expenditures, and GDP prices. Fine, 4 measures. Of the 4, 3 are below 3. Only 1, consumer prices, is above 3. The average of all of them together is 2.4. The Fed's target's 2. That sounds like we're getting pretty close, and yet the world doesn't see it that way. Why not?
Yeah, well, so I think if you look at inflation on an annualized run rate basis, you look at about things like super core inflation, which the Fed has explicitly guided to as being their North Star for inflation. We're running at 8% 3-month annualized on super core inflation. We're running at about 5% if you look at trim mean or median CPI. So we're moving in the wrong direction for sure. We don't know that this transitory blip up in inflation is sustainable, but ultimately we do believe that inflation is likely to bottom at a level that's inconsistent with 2% inflation.
Yesterday, we reported that the Chinese Communist Party said that economic growth was running at 5.3%. I'm not sure if I'm buying into those numbers. 5.3%. But you say the March activity in China is supporting your, quote, China front-loading stimulus. Tell us about that.
Yeah, so if you look at the breakdown, the GDP report from January, February, and March, the data really slowed towards the end of the quarter. We saw significant downside surprises in retail sales, industrial production. If you look at the property market, which represents 25 to 30% of Chinese GDP, those numbers are abysmal. You're talking about supply down 9%, demand down about 32% in the property market. So in our opinion, we think the PBOC is poised to continue supplying liquidity to the Chinese financial sector. That liquidity is spilling out into global asset markets and is one of the reasons we remain bullish over the medium term.
Bullish for
risk assets.
Okay. How do you want to allocate capital then?
Yeah, we're still in a reflation market regime. We're obviously experiencing a correction that we called for back in the beginning of this month. But the reality is we do believe that a lot of the fundamental themes that have driven asset markets higher over the last last couple of quarters, we believe most of those themes are still intact.
So tech. You like tech?
Tech, absolutely.
Yeah.
You like any high beta cyclical risk asset when you're in a reflation market regime.
Mm-hmm.
I'm with you.
Yeah.
And it's interesting that you're not intimidated by inflation staying higher for longer. You're still comfortable putting money to work, which is what I've been saying, but I feel like there's this wave against me on that idea.
Yeah, so the difference between a risk-on reflation market regime and a risk-off inflation market regime is a policymaker that is trying to curtail the higher than expected nominal GDP environment. Right now, we have a Federal Reserve that's concerned about it, but in our opinion, we don't think that we're going to see a full policy pivot back to official higher for longer, or even guiding towards rate hikes until you can get well into the second half of the year.
All right, we will leave it there. Darius, great to talk with you this morning.
Thanks
so much.
Appreciate it.
Darius Dale joining us.